Hi people, it's Sunday evening, 14 August, and I quickly want to do a recording for tomorrow's class. And I want us to focus on companies. And as you already know, most businesses on the international level are all companies. In other words, if I talk about all the different businesses in New Zealand, the majority of them consist out of company structures. In other words, the legal entity that they use in order to do their business, it's companies. So my objective with this short PowerPoint slide is simply to quickly focus on companies, and we're quickly going to look at the different types and then the requirements for incorporation. And then we're going to look at the advantages and disadvantages of making use of company structures as a company structure as a legal entity. Before we continue with this slideshow, I just want to ask you, give me the three main types of company structures that the law acknowledges or that we find in New Zealand. People, there's three types of New Zealand companies: limited liability companies, and these are the most common type, which you can often recognize because they have limited or LTD or tapui. Tapui is just the Maori word, but it means limited at the end of their name. So the moment that you see limited, LTD or tapui, you must know I've got to do with a limited liability company. And people, it's important. You must actually reveal that you are doing business in a limited liability entity. In other words, you can't not put the limited or the LTD or the tapui at the end, because the moment that you see those words, you must know, I'm doing business with a limited liability company. In other words, it can be like a bare shelf company. So I don't know how much they really possess. So I am supposed to be careful. Then people, we've got cooperative companies, and sometimes we just call them co-ops. These are also limited liability companies. They provide goods or services to their members or their shareholders who own and control the business. So something unique about a cooperation or a cooperative, cooperatives or co-ops, is basically the fact that the members or the shareholders own and control the business. Then we've got unlimited companies. People, this is quite rare, because why will you form a company and not make sure that you've got limited liability attached to it? Otherwise, what's the purpose of it? As they don't limit a shareholder's liability for company debts. So they are quite rare because, like I say, what's the purpose of doing business in a company structure if you don't have limited liability? When it comes to limited liability companies, sometimes people want a definition for it, or they want to know what the exact requirements are for a company to be able to exist. So the structure requirements, there should be at least one director. In other words, one director only, okay? It's individuals only that can serve as directors, not body corporates. In other words, an artificial legal person can't be a director of a company. And then we should have at least one shareholder. In other words, one director, one shareholder, and then at least one share. If those components are there, we've got a valid company. If we look at the incorporation requirements, we will see that basically there's a New Zealand registered office needed, a physical New Zealand address, not a postal box or a document exchange. In other words, a definite physical New Zealand address. No share capital is required at the moment of incorporation. At that moment, they're only interested to know how many people are going to be shareholders and how much shares each one will have. So, but usually people do it with a small amount of money. Let's say, for example, you can take $100 and you can even, there's no minimum requirement or requirement as to the minimum amount of capital. In other words, you can issue shares worth 1 cent each, no problem. A constitution. The adoption of a constitution is not compulsory. In other words, if you're not going to write a constitution for your company, you will simply fall back on the regulations provided in the Companies Act. There's always a registration fee applicable that you have to pay to the registrar, and that's $150. It can probably be cheaper at this point in time, but yeah, plus minus, let's say $150, and there will probably be another $10 involved for name reservation. So let's say it's going to cost you not more than $160 at this point in time. Tax registration is not compulsory if a company is not going to commence trading. But of course, it's always better to do it immediately, right from the start, the moment that you start this whole process of incorporation. There's the annual maintenance with the register of the company includes filing annual returns on an annual basis, of course, and financial reporting for some types of companies. Some companies, the moment that you've got a big turnover, you know, I will look at the amount. I think it's 30 or 60 million. I'll have to look at that. Then there's compulsory audit requirements. But the moment that there's more than 10 shareholders in that company, then there's also compulsory audit requirements. Of course, there's a way to get out of it, but it's not always recommendable because it's actually good. Some people see it as negative to have your stuff audited or the auditing requirements, but it provides for transparency, and then everybody knows exactly what is going on in the company. It's a good safety measure. So don't think twice before getting rid of it. And I'm not saying it just because you are studying accounting and I want to make sure that you've got a job. No, it's important that the company's financial statements are audited according to me. People, and you may pay taxes on worldwide income. Like always, please pause the recording for a moment and first give me 3 advantages of a company. Why will you make use of a company structure? People, some of the advantages or the upsides of companies: you will have greater access to finance than in any other structure. In other words, it's the easiest structure to use to generate income or to generate more finances that the company can use. Okay, and another advantage is, of course, the limited liability. But the problem is, oftentimes, the moment that the company wants to borrow money and funds, the directors have to sign. And the moment that you've signed surety for that loan that you've made in the name of the company, you've basically defeated the purpose of the limited liability, because then you're going to be personally liable due to that signature. So just keep that in mind. I've done it myself several times, and but yeah, there's usually after a certain time, say for example, if I buy a property in a company structure and after a certain time I realize, okay, now I've got adequate collateral because of the increased property prices, I will just go back to the bank and say they must please relook at it. But the surety that I've signed, I want them to to cancel it. I don't want to be personally liable. And usually if they then look at the amount of collateral, they do not really have a problem with it. But if you're not going to do it, they will never do it on their own. Okay, something else, a big advantage is the unlimited lifespan that we've got in a company. And remember, I've told you, we've call it perpetual existence. In other words, it will exist theoretically forever. And then another big one, people, in a company structure, we can use expert management because we can employ professional managers to be the directors of the company. So that's all big advantages that we've got in a company structure. People, some of the negatives or some of the downsides when it comes to companies is that the taxation is indirectly higher than the so-called 28% that they say. And this is based on the fact that you will have to pay taxes in the corporate entity as well as for the dividend income. You will also pay taxes on the dividend income. In other words, there is an imputation credit scheme that will give you credit for the 28% that you already paid within the incorporated entity. But remember, that moment that you receive that dividend money in your hands, you will also pay taxes on it. And that's why usually you will pay 5% on top of the 28% that you've already paid. So it will be 33%, and there's no way that you're going to get it in your pocket for less than 33%. The only advantage of the 28% is basically the fact that it's not really a lot of money that you save if you really do the calculations, but yeah, the little bit of extra money that you can maintain within the company can at least help you to more quickly build the company. People, there's a lot of statutory provisions when it comes to companies. Some people say the environment, the business environment in New Zealand is totally overregulated. Basically, to be honest with you, it tired me out as a business owner, and all the compliance related stuff. I later on decided, no, you know what, it's just easier to go and take a job, especially because I'm getting older. A lack of personal interest is often found, especially when it comes to the directors involved in the business or in the company structure. Oftentimes, they've got their own hidden agendas. They only want to become director or basically to have it on the resumes and so on. And yeah, they often busy looking out for other jobs, and their hearts are not really into it. Okay, and then you've got higher setup and maintenance costs due to all the legal requirements. And another big one, people, there's a lack of confidentiality. I can show you now, I can give you my company, just the name, and immediately you will get my wife's details, my details, everything. So if you really want to stalk somebody, people, the easiest way to follow is just to go to the company's register if they are involved in a company structure. Directors need to clearly understand their responsibilities in a company structure, and then the limited liability advantages are often eroded in practice by the need to provide personal guarantees to lenders or creditors. And this is exactly what I've told you. The moment that you want to borrow money from the bank, you have to sign. You have to sign surety. And then the limited liability advantages are defeated or eroded. Can you see it? Some of the IRD requirements: when you set up your company, you may apply for tax registration and get a taxpayer number. People, IRD number, that's in short what it is. A company must also be registered for GST, that's goods and services taxes, In other words, you've got your direct taxation, pay, but then you've also got your indirect taxation, which is basically the GST. If its turnover, its sales and income for the last 12 months was more than $60,000, or if the turnover in the next 12 months is expected to be more than $60,000. As soon as a company goes into business, it needs to start keeping records. In other words, of all the income, the profit, the losses. There's supposed to be an asset record, or records of the assets, depreciation records, and so on. The breach of these obligations may cause a fine of up to $10,000. So instead of paying the fine, make sure that you keep accurate records. The Companies Act of 1993 permits investors to form a company on delivering the prescribed application form. In other words, you submit the correct form, and consents of shareholders and directors to the company office, and you pay a prescribed fee, and in exchange for that, in return, the state will confer you the privilege of limited liability on those investors. In other words, they will see the company now as a separate entity. They will put a circle around it. It's not part of your assets. It's now part of the company. This means you as a shareholder, or the shareholders, they will only be liable for the amount that they have agreed to pay for their shares in the company. In other words, the amount that they've invested in the company. And from there, we get the term limited liability company. In other words, you can only lose the money that you've invested in the company, and not a cent more, the moment that there's LTD at the end, or Tapui, or it's a limited liability company. Limited liability company, often we just say a LLC. Okay, people, I want to give you some handouts, but I've decided to put a link here for you. And so I will send you the slides, and just go to this link and read it. It's interesting, and I think you can learn from it. It's people with a little bit of practical insight, and sometimes it's good to read through that, because you can learn from other people's experiences. What is a cooperative? Co-ops. People, it's really interesting. If you go to the Cooperative Companies Act of 1996, everything about co-ops are set out in it, and you can really learn a lot. All your answers will be in the Cooperative Companies Act of 1996. So, but the definition, basically, it's an organization owned by and democratically operated for those using its services. So a cooperative is an autonomous association of persons united voluntarily to meet their common economic and social needs and aspirations through a jointly owned and democratically controlled enterprise, organized and operated on cooperative principles. Cooperation, people, you can hear where the name comes from. It's to work together as a group of people. It is established by a group of individuals, and the group must also have a mutual or a common need or purpose for forming the cooperative. The common need should be capable of being met more economically by the group than by an individual. That's why, say for example, if we form a cooperation to buy stuff cheaper, in other words, we form a cartel. Due to numbers, we can negotiate to get stuff cheaper. Okay, and exactly the same thing. Selling stuff, we can kind of like create like a monopoly. Like what we're doing with Fonterra, for example, the farmers they do not want to compete against each other in the international market. So all the farmers in New Zealand basically united under the umbrella of Fonterra, which is a cooperative, and then they market their milk like that, the dairy products like that, through Fonterra on the international market. So basically you can form a cooperative to buy stuff or to sell stuff. The activities of the cooperative must be of mutual benefit to all members. Their main purpose as an economic unit is to promote their members by rendering services rather than to maximize profits. In other words, over here, profit maximization is not the goal, but service to the members. People, cooperatives operate like any other business, but they do have a number of unique characteristics. They are owned and democratically controlled by their members. I've already explained this to you. In other words, the people who use the co-op services or buy its goods, not by outside investors. Like in a company, you've got shareholders, it's the outside investors that own the company, but over here they own it, they democratically control it, the members, and yeah, the same people that use the co-op is basically the shareholders, not outside people. Okay, even though there's a little bit of there's small exceptions, because Fonterra opened up for investors on the outside and they've created special units. Okay, but to be honest, it's not really, I don't think it's really worth wasting your money on that. And then they return surplus revenues to their members in proportion to their use of the co-op, not in proportion to their investment or share ownership. So this is something unique as well. They are conscious of the need to operate profitably rather than at a loss. Co-ops meet their members' needs either by buying members' produce at the best price or by providing affordable and high quality goods and services rather than maximizing the co-op's profit. And they exist primarily, and this is very important, to serve their members. Because remember, they are owned by the members. They pay tax on income kept within the cooperative for investment purposes, and that are kept as a reserve, while the surplus revenue from the co-op are returned to the members, and the members will then pay tax on that income according to their different scales. People, that's basically all that I wanted to give to you in this slideshow, because the whole of this course, the rest of the semester, we're going to basically focus on companies. So you will eventually know everything about companies. But there's just some general concepts that I also want to discuss with you, and it will follow now below this slide. Whenever we talk about law of business entities, remember, terminology is important, and sometimes you will see landlord and sometimes you will see freeholder, but it's the same thing. We've already done this, so this is basically a revision, but freehold property can be defined as any estate which is free from hold, or any entity besides the owner. Hence, the owner of such an estate enjoys free ownership for perpetuity. It's the state or quality of lasting forever, and can use the land for any purposes, however, in accordance with the local regulations. A way that I usually explain freehold or free from hold, I take my laptop and then I hold it on one corner, and then I ask 3 students to hold the other 3 corners, just to show them that I can't do with the laptop what I want to do unless I've got their hands completely. If I can get rid of their hands on my computer, then I'm the only one holding the computer. Then it's free from their hold. So I've got the free hold, okay? And then I can use it. So, but it's just my own personal way of explaining it to people. If we look at old established businesses, possibly in a family for more than one generation, it may be fully owned by the family. This is where we get freehold property a lot of times, especially in farming. More than likely, the property has been used as collateral to raise capital for redevelopment or other investment options. Freehold and leasehold land give different ownership rights. In other words, freehold ownership gives total unencumbered ownership. Remember when we were talking about the bundle of rights, this is where you've got the total bundle. All the rights in the bundle is in freehold. Leasehold ownership, on the other hand, it splits the above rights between 2 parties. Those who own the land, the lessor, and those who then lease the land, the lessee. People, the transfer of land or real property is done through conveyancing. The process is almost completely in the hands of the solicitor profession. That's basically their bread and butter work. Something else, all land in New Zealand belongs in theory and in law entirely to the Queen. And this is what we call eminent domain, with the exception, of course, of Maori land. And in an estate is a length of time that the person has a legal right to occupy the land. Freehold estate, another terminology, another phrase that we use is fee simple. And it's the highest right a person can have over land. Freehold is indefinite in time, unless it's sold to someone else, or unless the Crown reclaims the land for some reason. If it does, it must pay compensation for doing so. A leasehold estate is measured in months or year. A number of leases in New Zealand are for 99 years, and when we come to cross lease agreements, I've told you we can get them going up to 999 years. People, whenever you see the following terminology, lease to buy, it's not that well known. It wasn't that well known in New Zealand. It was actually, most people do it like that in South Africa. When I suggested it, when I came over here, I said, no, I want to lease with the option to buy. The real estate agents told me, no, we are not doing it over here in New Zealand. But now it's become something more well known. More people know about this and do this, but it's basically the leasing of land or property with the option to eventually buy it, and it's becoming increasingly popular. To me, it's the preferred option, like I've said, and it's good for stuff like share milking, where you basically rent a farm but with the option to eventually buy it. In other words, you've basically got the sole option, the option. But there are a range of issues that need to be considered. It's important to take adequate professional advice and from suitable and qualified people, but most importantly, you have to respect each other, the different people in the agreement, and respect the relationship that you have, because this is crucial to your business well-being, the longevity and survival of the business.